Today's investment wisdom comes from Warren Buffett's 2000 letter to shareholders, which was written after the dot-com bust earlier that year. As such, it was apt of Warren Buffett to remind the investing community the difference between investing and speculation. Warren points to an old axiom by the oracle Aesop that is applicable to evaluating companies. Many of you will have heard of the axiom before: a bird in the hand are worth two in the bush. Warren explains that if you can know the answer to 3 questions in regard to this axiom, you're able to know the maximum value of the bush and thus able to rank the attractiveness of all possible uses of capital throughout the universe. The 3 questions are: how certain are you that there are indeed birds in the bush? When will they emerge and how many will there be? What is the risk-free interest rate? That's it. Those are the deceptively simple questions that you need to answer in order to know the maximum value of the bush. Of course, Warren Buffett isn't really talking about bushes and birds. Rather, he's talking about companies and how much money or value the companies are able to generate. Out of the 3 questions, the risk-free rate is the easiest to answer. Warren suggests that you can use a long-term yield of a US-backed government bond. Now, why would you want to know the risk-free rate? Well, the risk-free rate is kind of like the opportunity cost for any investment, because an investor can always choose to invest in a US bond versus any other investment. It's quick and rather easy to identify the yield of a long-term US-backed government bond. All it takes is a quick scan through the financial section of a newspaper, Google Finance, Yahoo Finance, or a host of other financial-oriented websites. The other 2 questions are much harder to answer and requires a large degree of guesstimation. How certain can one be that there are indeed birds in the bush, or in other words, how certain can we be that a company will generate money? As anyone with a get-rich-quick uncle will tell you, many business ideas sounds plausible or downright appealing on paper, especially combined with the euphoric investing environment as seen in the dot-com era. But to be able to analyze a company, especially in the early stages, of its potential to generate profits is a challenging task. It requires extensive knowledge about the industry that the company operates in, who is operating the company's competitive advantages and weaknesses, and threats. Even professional venture capitalists, whose sole job is to evaluate the financial viability of companies, have a difficult time evaluating if a company they are invested in will ever make money. According to the Wall Street Journal, 3 out of 4 startups that venture capitalists fund fail to ever make money for its investors. The remaining question, and probably the most difficult question: when will the birds emerge and how many will there be? If it's difficult to analyze if a company will be profitable, it's monumentalist to analyze how profitable a company will be and when you can expect profitability. I'm reminded of another saying that business owners would probably recognize or not in agreement: man plans and God laughs. There are simply too many variables to analyze and model to come up with a concrete number for when and how profitable a company will be. Warren Buffett recognizes this Herculean task and posits that using a precise number is, in fact, foolish. Working with a range of possibilities is a better approach. However, Warren Buffett points out that usually the range must be so wide that no useful conclusion can be reached. Warren Buffett just underscored why it's so difficult to invest in individual companies. Too many variables and considerations to be able to generate concrete numbers, and if you use too wide a range, then any estimations that you come up with is useless. It's kind of like trying to estimate how long you're going to live for. Far too many variables to know for sure, but saying you'll live somewhere between 0 to 200 years isn't really useful. These are the mental exercises that, according to Warren Buffett, you must engage in when you're investing in an individual company, and if you don't or can't, then you're speculating. There are many times when the most brilliant of investors can't muster a conviction about the birds to emerge, not even when a very broad range of estimates is employed. This kind of uncertainty frequently occurs when new businesses and rapidly changing industries are under examination. In cases of this sort, any capital committed must be labeled speculative. Warren Buffett is quick to point out that there's nothing per se wrong with speculation, neither illegal, immoral, nor un-American, but you have to recognize when you're speculating and be rational about your decisions when speculating. Warren points out how effortless money sedates rationality, and even when you know that you're speculating and you have to exit before the bubble pops, it's much too tempting to continue dancing while the music is playing. They know that overstaying the festivities, that is, continue to speculate in companies that have gigantic valuations relative to the cash that they are likely to generate in the future, will eventually bring on pumpkins and mice. But they nevertheless hate to miss a single minute of what is one hell of a party. Therefore, the giddy participants all plan to leave just seconds before midnight. There's a problem though. They are all dancing in a room in which the clocks have no hands. Warren goes on to warn that during euphoric investing environments, like those seen in the dot-com boom, Wall Street and investment bankers are less concerned with value creation but with wealth transfers, and mainly wealth transfers from the investing public to the pockets of bankers. By shamelessly merchandising birdless bushes, promoters have in recent years moved billions of dollars from the pockets of the public to their own purses, and to those of their friends and associates. The fact is that a bubble market has allowed the creation of bubble companies, entities designed more with an eye to making money off investors rather than for them. Too often, an IPO, not profits, was the primary goal of a company's promoters. At bottom, the business model for these companies has been the old-fashioned chain letter, for which many feel-hungry investment bankers acted as eager postmen. Be especially careful near the tail end of a stock market boom. That's when investment bankers are more concerned about the marketing and selling of IPOs than creating real value in real companies. Of course, the difficult part is knowing if you're near the end of the bubble before the bubble bursts and everybody's stampeding through the tiny exit. Thanks for watching. I hope you learned something from Warren Buffett's letter to shareholders. Please consider subscribing to the Strange World of Econ channel. It's a great free way to support the channel so I can bring you more investing advice from legendary investors. Till next time.